I'm Jim Loeffler, CPA, CFE, MBA, and founder of InTune Business Advisors, where for more than 20 years, we've helped owners transform their manufacturing businesses into financial freedom through superior business valuation, growth, and exit planning services. Today, I want to talk about a line of credit, and specifically what it is, what it's used for, how you get one, the costs involved, and other considerations. Let's go. What is a line of credit? Well, a line of credit is a great tool that you can use to manage your short-term cash flow needs. Let's say, for example, that you've got to make payroll next week and you're expecting some customer invoices to come in and to be paid, but you're just not sure when those are going to be paid. Well, a line of credit will allow you to draw down from your lender and make payroll. And then when those invoices are paid next week by your customers, you just go ahead and take those funds and you pay that line of credit off. Okay, so it's a fantastic tool for smoothing out your short-term cash flow. Because let's face it, cash flow in a business, especially in manufacturing, is not always smooth sailing. Let's talk about how you can secure a line of credit. And there's an old axiom in finance, and that is secure the financing when you don't need it. And this is certainly true with respect to lines of credit. Banks and lenders are going to want to see a number of things. First of all, are you profitable? Has your business been profitable for the last tax year? Let's start there, okay? The second thing they're going to want to look at is whether or not you're generating positive cash flow. And again, they'll look at the last year or so. Some banks may go back farther than that. But typically they're going to want to know, okay, does this business have positive EBITDA, which is earnings before interest, taxes, depreciation, and amortization, or they may look at your operating income. They're going to want to know, do you have positive cash flow? And how long have you been in business? Have you been in business for a minimum period of time? Some lenders will say 1 year, others will say 3. All of these things that I'm talking about here are going to vary from one degree to another, depending on who you talk to. Okay, but if you can put forth and you have those characteristics, then that's going to really help you secure the financing that you need without paying an arm and a leg. Now let's talk about the size of your line of credit. How much will the lender be willing to lend you at any given point in time? Well, that's going to depend on a number of factors. Certainly, the fact that you've qualified for the line of credit through the financial metrics I talked about earlier, that's one indication. Obviously, the more profitable you are, the better your cash flow. All of those things are going to make a big difference, but it really comes down to these. Your annual revenues. They're going to look at what percent of revenues their lending criteria may indicate. The second is going to be the average level of your receivables and the average level of your inventories. And typical ballpark percentages are that lenders will lend 80% on receivables and 50% of inventories. And as your AR and inventories fluctuate, your line of credit, the availability, will go up and down subject to a ceiling. The quality of your receivables and inventory are also going to be major factors. So if you have $300,000 in receivables, but 100,000 of those receivables are more than 60 days past due or 90 days past due, they're really not going to be considered in this calculation. So that's just an example. And of course, you want to make sure that your inventory is healthy and turning as well. But look at the size of the revenues, your AR and your inventories are really going to determine how much the bank is willing to lend. Now, obviously, the lender isn't doing this for free. So let's talk about the fees and the interest rates that you can expect. And let's start with the fees first. The lender may charge an origination fee, which is basically a small percentage. It might be a quarter point or 0.25% or 0.50% up to maybe 2% of the total credit limit, just to get the paperwork going and open the account on their end, etc., to monitor it. Then you're going to have, typically there's an annual maintenance fee, and that is their charge. And again, a small percentage, maybe 1%, maybe 2% of the total credit limit each year for the bank setting aside those funds to potentially lend to you when you need them. They could also be a flat amount. It could be $100, it could be $1,000. Again, all depends on the lender. You're also going to have a draw fee, which again, it could be $100 or $200 or it's going to be a small amount, but just be aware of that every time that you draw down and use a line of credit, there's going to be a charge for doing that. There are a whole lot of other types of fees that lenders may or may not charge you, but the ones I mentioned are the most prevalent. Prepayment penalties, that type of thing, that's becoming more rare these days, and obviously read the fine print. But now let's talk about the interest rates. Your interest rate is basically going to depend on a number of factors, okay? Again, the quality of your earnings and your cash flow. But if your line of credit is unsecured, meaning it's based purely on a percentage of your revenues in terms of how much the bank is willing to lend, then what they're saying is, okay, we're not going to look at your accounts receivable or your inventory. We're not going to secure the line of credit with those assets. So in the case of where things go south and the bank wants to collect the outstanding balance on the line of credit, it will not be able to sell your receivables or liquidate your inventory. Okay? But in exchange for not doing so, the bank is going to charge you a higher rate of interest. Compare that with a secured line of credit where the line is going to be secured by your accounts receivable, typically 80%, or your inventory, typically 50%. That will bring the rate down significantly. So those are the costs, generally speaking, of a line of credit. Yes, you're going to have some fees involved. One I didn't mention is if you're going to get a secure line of credit, the bank's going to probably charge you an appraisal fee for looking at the quality of your receivables and your inventory. But the big one, obviously, is the interest rate. Finally, there are a couple of other things you need to consider with respect to a line of credit. First of all, and most importantly, you need to make sure that you're always using your line of credit for the right purpose. Never let that line of credit, the balance, hang out there if you don't need it to hang out there, because obviously you're not only incurring interest charges, but you're also diminishing your overall financing capacity in other areas. You always want to pay that down and pay that off whenever possible and use it in emergencies. The second thing is, a lender may require you to move your banking relationship over to them. So if your current lender is not giving you a line of credit, or at least a line of credit with the terms that you're looking for, and you have another lender over here that's courting you, be prepared when they say, we would like you to move your checking and savings accounts over to our bank. And that is fairly typical. So just be prepared for that. And, there are switching costs involved in doing so. So that's it for this week's video. I hope you found this discussion of line of credits and the benefits, how they work, what they cost, informative. And I'll see you in the next one. If you're planning on growing through acquisition, securing growth capital, or selling your business in the next few years, or even in the next decade, click the link below to schedule a free call with me. I'm happy to answer any questions you have. Remember, you know your business better than we ever will. Let's make sure you get a great price so that you can enjoy the financial freedom you deserve. I'm Jim Loeffler. Get the insight, get the value, get in tune.